Hey everyone, John here. It has been a moment. A lot of things have been going on in my life. I just had my first Brazilian Jiu-Jitsu competition. It was a national one. I won the gold in my category. So, thank you everyone. And I'm also studying for exams, as you might know. So the videos have not been coming out as regularly. But I'm still keeping an eye out in the market, and I got to say, when we last spoke, the market had hit a bottom for this recent bear market that we were in. Well, not bear market, but a small correction. And since then, we have been in a V-shaped recovery, currently at all-time highs. My portfolio has returned to almost an all-time high. Not quite there yet. As you know, I did the most of my buying. Unfortunately, I started late. I should have bought right around here in 2022 or even in 2019. But better late than never. I bought most of my stocks right over here, some stocks over here, and now a lot of stocks over here. And I'm happy that I did that. I think that us young guys need to be buying the dips when they come our way. My biggest stock is doing great, which is AMD, by the way. I started the position out at about 6% of my portfolio, and it has grown now to be around 14% of my portfolio. I was buying right over here, most of my stock over here, then a little bit over here, and then over here as well. So my median price is right about here, I think, right about over here, but it has appreciated by about 200%, and I'm not looking to sell just yet. It is, as I said, about 16-15% of my portfolio. I'm okay with AMD right now. I think that it is going to appreciate very well in the coming AI boom, and I will be looking to trim my position when I reach like 20 or 25% of my total portfolio, in order to protect, from unforeseen events. But I'm actually very, I'm good. I'm good with AMD. I'm not afraid at all. So today I don't wanna speak about any company, any stock, as I usually do. Although I do have a lot of stocks that I'm watching right now. I'm not looking to buy most of them. Maybe we'll actually only one or two, but maybe we'll speak about that in the future. Today, I want to do something different. I want to try and react to some videos about the stock market. I have three videos over here. Haven't watched them. We're going to watch them together, and I'm going to give my commentary about them. So first up, we have Tom Lee on CNBC.
It's obviously a lot going on outside of the markets, but the market itself does seem to be kind of looking past the war in Iran, looking past any political event. What is the market the most closely looking at right now?
Well, I think the market at the start of this year maybe had three risks it had to get comfortable with. One is Iran and a war, potential escalation.
Well, totally. The geopolitical risk was over there. We knew the geopolitical risk, China, Iran, the Middle East in general. But I don't think that anyone could, predict that there would be a war, actually.
A second was private credit, and the third is a new Fed chair. And what we've seen, I think.
Well, the new Fed chair, I don't think that it is that bad of a deal. Mr. Trump was going to put someone on the chair that he was going to work well with. So I think that that would be a tailwind rather than a headwind. And yes, of course, the private market risk is still there.
Is that we've come out the other side of this Iran war with the economy showing remarkable strength.
Are we really, though, on the other side of the Iran war? I think that it's still a little bit too early to blow the whistle.
In fact, earnings estimates have been going up. So I think we passed that test. And I think the underwriting for the private credit looks better than expected. I think that's why IGV is rebounding. And so I think the upside.
What is IGB?
Oh, sorry.
So he's going to explain it. So
the software ETF.
Okay.
Because that fell all the way down to 72. It's back to 85. And so a lot of private credit loans were tied to software. I think that is looking less of a structural problem. And so to me, this means.
I think that for us retail investors, I had made a video about that. It was a great opportunity to buy software stocks. I did buy a lot of software stocks myself. I have Adobe, now I have CRM, And I think that it's still a good opportunity to buy all of the stocks. They're still, way low on the valuation. And although I was early to buy the Adobe, I'm down 30% of the position, 35%. I think that most, stocks in this sector are undervalued and a good opportunity to buy maybe 1, 2, 3% position, nothing extravagant.
I think for stocks for the year, the upside case is strengthening. I think S&P above 7,700 is very probable.
What other are the kind of planks that feed into or build into that?
Well, I think one is earnings estimates are higher. And now we're seeing AI, I think, deliver productivity. And, earlier on CBC, Torsten was talking about how there is the positive case for AI, which is, business growth and company formation. And
I am extremely bullish on AI. I can't tell you how bullish I am. I'm right over there. I mean, if the internet is over here, AI is over there. Okay, I think that a lot of people are going to lose their jobs. I think that AI will also create some jobs, but not as many as it is going to consume. And I think that it is going to boost companies' earnings way high, way up there. And I think that if you have money right now, you need to invest in AI. It's far more likely that you are not going to be able to outperform, to find work, to do all this stuff, than AI failing. Okay, I think that we're at a time point when, it's like discovering America, going to the moon. We have the AI frontier over here. You need to learn to use it, and you need to invest in it, okay? If you want to have some security in your future.
And I think risk premia later this year drops because if we settle the issue in the Middle East, you're taking out, hostile oil premium that's been priced in oil for a long time. So I think that allows markets to lift higher.
Oil is still at $95. I think I tweeted out this morning that the market was kind of in the settle-in mode. I think that oil hasn't moved really in a week or two. We're kind of now in this sort of stasis, if you will, with regards to that. Because I think you said on this program a couple of weeks ago that the war was the most important thing in the short term. What are the two possible outcomes for the markets vis-a-vis Iran? Best case, worst case?
Yeah, and these are pretty big.
Well, I think that the war in Iran dip actually has ended. I don't think the market is going to dip very much unless something major happens, like actions, rather than words. And even though I don't think that it's going to end anytime soon, like completely, I think that as far as the stock market goes, we're out of the dip.
Yes, they are.
It's on two very far sides. I think one is an extended war, and therefore it's a mirage that oil prices are low.
Well,
because now we're going to have a drawdown
in
on inventory and lost production. And so I think price for all petroleum products jumps dramatically. And then that puts a lot of global growth at risk. The other side is the war is resolved quickly, and that's through all the combination of pressures. I think the market is betting on a shorter war at the moment.
So a lot of the times, in recent years, we've talked about stocks and bonds, but the strong performance of commodities.
Hopefully the market is not going to overreact if the war goes longer than they think. But if they do, we are here to buy the dip.
Has Michael Hartnett, Bank of America's chief investment strategist, saying a better portfolio positioning right now would be what he calls the sleep like a baby portfolio. He says it's an equal weight allocation across stocks, bonds, cash, and commodities. According to Hartnett, this four-way split.
I think that if you're young, in your teens, 20s, 30s, maybe even 40s, you need to be in stocks much heavier than bonds and commodities. And you always need to have some cash to buy the dip and, cover some basic needs that might arise out of the blue. But I don't think that bonds are actually a good allocation for us young guys. Maybe a tiny little bit, like 5 to 10%, and then maybe you can sell these bonds and go into cash and then buy some stocks. But I think that for me personally, I'm like 95% into stocks. You don't need to do what I do, but I think that it's the best way for your wealth to appreciate.
Is having its best year since 1933 and delivering one of its largest relative wins ever versus the traditional 60-40. Now, we all know every strategy can have a good year. It's like a broken clock, right? But is this a working clock that people should think about this kind of allocation and sticking with it?
I mean, there's a lot of logic to that because one, We know that gold's been a really good total return performer, and so I think gold should sit in portfolios, which probably sits in commodities along with crypto.
I'm not going to speak a lot about gold. I think that the ship has sailed. It appreciated way too much. It was sitting idle for way too long. And then, in like 2-3 months, boom, gold is to the moon. If you missed it, you missed it. I don't think that it is time to buy gold right now.
And then I did hear someone earlier this year point out NASDAQ and oil are actually good counter hedges. So
Yes.
in some ways, that portfolio does make a lot of sense.
In fact, the technology and energy have kind of been these, two sides of a balance. You'll have a decade where energy does really well, and then a decade where technology does really well, back and forth. And what's interesting right now is that both of them are kind of doing well. And
Yeah.
maybe your point is you don't have to pick, just own a little bit of all
Yeah,
of
and
them.
AI is pulling both of those.
Well, yes, AI is pulling both, as Tom Lee was going to say, it's pulling both technology and energy very high. AI is the future. If you ask me, I believe that is the future. I might be wrong on that. And it requires a lot of energy, so bullish on both of them. Unfortunately, I did not manage to invest into energy. I should have done that. But if there's a dip, I'm going to add some energy to my portfolio.
Those together anyways,
Exactly,
right?
exactly. And kind of changing a little bit. We spoke with Roger McNamee last hour. He expressed some concerns about what's happening with these AI models because the OpenAI in particular doesn't have the revenue to justify its CapEx right now. And we're about to go into tech earnings where all the focus is going to be on CapEx. Do you have any concerns that there isn't going to be a pot of gold at the end of this CapEx rainbow?
Well, I am heavily invested into AMD. I have some Nvidia, and I also have Amazon, Google, Meta, and Microsoft in my portfolio. I think that if they keep spending on capex, that I think that they should, because AI is nascent and it still has a lot of room to grow. Then AMD and Nvidia are going to keep going higher, especially AMD. And if they don't, then Google, Amazon, and all these companies are going to have their stocks appreciate. So I think that my portfolio is good either way. But I do hope that companies are still going to keep investing in their future and our future along with theirs.
Yeah, I mean, it could play out several ways. Of course, there could be some breakthrough where power consumption drops. But as you know, we are consuming every piece of compute. So to me, it does seem too early to worry about that as well.
Okay, CNBC. Tech shares fall after OpenAI CFO admits worries about future compute bills.
It's not the only stock
Take a
on the
look at
move
that.
from this report either. Christina Partsenevelis has more. Christina?
Well, Kelly, chips are the other sector really getting hit after this Wall Street Journal reported OpenAI CFO is worried about paying future compute bills. And so that's what's hitting the sector. NVIDIA, AMD down about 3%. Broadcom also selling off. You can see just a sea of red today. But investors are saying there's nothing genuinely new here. Semis were up roughly 40% month to date before.
Well, OpenAI is in a precarious position because they don't really have the money that they need to spend and they want to spend as of yet. Their IPO has not started yet, and it needs to generate a lot of cash in order for OpenAI to be able to do all the things that they say they want to do. And there's also Google with Gemini and maybe even Anthropic with Claude that is running ahead of them. And so, yes, maybe OpenAI will not be able to pay for their compute, but this is not the end-all, be-all of AI.
This news came out. The group just really needed a reason to pull back, and this is the reason. And remember, too, OpenAI just raised $122 billion, the largest funding round in Silicon Valley history. So the bulls will say there's cash there for them to spend. There is important context on the exposure, though. OpenAI is on the hook for roughly $1.4 trillion in infrastructure commitment across Oracle, Kelly, you just mentioned the $300 billion, Microsoft, potentially $100 billion with NVIDIA, Broadcom, Amazon, CoreWeave, the list continues. But most of these are letters of intent or milestone-based, not actual signed take or.
That's true, and I think that we shouldn't, we should take everything OpenAI says with a pinch of salt. They had said that they were going to be exclusive with Microsoft and their Azure, and now they say that they're not going to be exclusive with Microsoft. And, these deals come and go, they change. I think that the sector is going to boom as a whole. I think that Azure and AWS and Google Cloud are all going to benefit either way. I'm not so sure about Oracle and CoreWeave, but the future will tell.
pay contracts, aka they're not going to be paid out full term right away, in the revenue line for OpenAI. The two companies most directly tied to OpenAI are actually pushing back a little bit. Oracle telling CNBC.
I actually wanted to invest in Oracle. I was thinking about it a lot when it had this big dip, but I'm not so sure about Oracle. They have way too much debt, and I'm just not sure about that. I need to research it further. If you have any thoughts on Oracle, maybe drop them down in the comments.
Quote, it's incredibly excited about the partnership focused on delivering the capacity OpenAI needs. CoreWeave making a little bit of a different argument that OpenAI is a, quote, terrific partner, but not its only one, pointing to a diverse customer base, including Meta, Google, and saying demand continues to exceed supply across the AI ecosystem.
Of course, CoreWeave would be, crazy to just partner up with OpenAI and leave all these other great companies behind. You don't put all your eggs in one basket, like we don't put all our eggs in one basket as investors. We need to invest in technology, software, basic materials, healthcare, all the stuff. CoreWeave needs to invest in other companies and other partnerships as well.
And that's possibly the part the bears are missing. The entire ecosystem is short on compute. Theory Ventures noting NVIDIA GPU rental prices surged over 100% in just 6 weeks. That just speaks to the level of demand.
That is shaking crazy. Way. Wow.
For these chips. Intel, they just had in their earnings report last week that they are hiking prices of their CPUs, their central processing units. Memory demand keeps.
Congrats to everyone who's an Intel investor. I'm not an Intel investor, unfortunately. I did hold some Intel way back in the day when I first started investing, and I was buying companies that I knew about rather than researching them, and it didn't go very well. It was a very small position. I sold it. I still think that Intel is nowhere near the level of AMD, and although because of the AI boom is going to have some money come its way, I don't think that it is a good long-term play.
Keeps exceeding supply, which is why companies are willing to sign on with these 1 to 3 year deals. And tomorrow, every hyperscaler reports. And the base case is they just all talk up CapEx. So the demand picture doesn't appear to be breaking. It's just the soaring AI hardware sector that maybe needs a reason to breathe, Kelly.
Good. So let's see what Jim Cramer has to say.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere. Gardener. Pretty lame, tame hobby by Wall Street standards. Built my first garden in 1988. We gardeners, we love sun. We love our flowers basking in the glow. On a sunny day, we can almost feel the plants grow. But too much sun scorches the heck out of the plants. You can burn out the tomatoes.
Stop talking about plants and start talking about stocks, bro.
NASDAQ shed 0.90%. Was uglier at one point. Pretty ugly. So tonight I want to sing the praises of rainy day sell-offs like this one and explain how to use them and why you should like them. First, let's look at what happens when you don't get
1%, 0.9% is not really sell-off.
enough rain. That is the story of the great run-up at the end of the dot-com bubble from 1999 through the first quarter of 2000 that people are always referring to, but didn't live through it like I did. If you weren't around back then, you might not know that there was almost no rain in that market, just scorching sunshine day after day. We had stocks of worthless companies going up and up and up, nurtured by the sun of reckless buying by both individuals new to the market and growth.
Well, he's right about that. I don't think a lot of investors are comparing the dot-com bubble with the AI run we're experiencing right now, and I think that investors have learned from history, and it's not exactly the same thing. Maybe the build-out is going to be, maybe companies are going to build out a lot infrastructure for AI, a lot more than they need, but I don't think that we're there yet, and investors are ready to punish companies for their spending a lot more now than they did in the past.
Both craving mutual funds who just were the scourge of the market. These buyers never took a break. If you got to sell off, it was only for just a couple of hours, not days, as buyers could not resist throwing money at anything that looked like an internet company when that helped them. It was a market full of what we call parabolic moves. That's where stock.
And I wasn't investing back then, but that's what I hear, that everyone was investing in anything that had a .com in its name. And even though we have been hearing some stories, like, that shoe company that sold its brand and went in to invest to AI, and so its share price appreciated like 600% or something like that overnight. I think that we're far more sophisticated today than we were like 20 years ago, and I don't think we are there yet for a massive drop down.
Stocks go straight up and never even go stair step. This is a pattern, by the way, I don't mind at all. What only happened in this Mojave Desert style of bull market? Pretty simple. We went up so much that we were deluged with two things: secondary offer, finally, and under this giant fund ending never gets. Sure enough, the entire group collapsed in the fourth quarter. Many people again got hammered, but fortunately nowhere near the destruction of year 2000. Many of you are still with us. Despite what you may hear right now about the data center and the overextended nature of a handful of stocks, this period is nothing like that one. Sure, we got too many power.
Just as I said, Kramer agrees with me. This period is nothing like that. We're not there yet. Don't let people fool you. Well, not fool you, scare you, actually. You should believe in yourself, do your own research, not even listen to me, but don't get scared.
Parabolic moves, but unlike the dot-com era, the year of magical investing, the companies that are moving up strongly are real, meaning they have sales and earnings, and their prospects are extraordinary. Many have great balance sheets, especially if they're in memory or storage or processing of data. The bad news.
Premise is right about that. The real companies, they have real cash generation, but I would not go and put my money in companies that have appreciated too far, like in memory companies right now. These companies might flip very quickly if the sentiment swaps. And even though this might be the case for AMD as well, it has appreciated a lot. I think that it still has room to run, but I wouldn't go and put like 15-20% of the portfolio right now in AMD. I do think that it is a good it's in a good spot to buy a little bit and maybe go up another 100% in the next year, 2 years, 3 years. I think that it is going to reach like $600 by 2 or 3 years, but that's just my opinion. I'm not sure. I have an entry point of around $120, $130, and so it's very different to buy the stock at 130 and 300. Even if it drops, I don't think that it's going to go below 130 again. So I don't think that I'm going to lose my initial value. But if it drops, it might drop below the 200 point.
The news, though, is the if in that sentence. Today, the Wall Street Journal ran a story that basically said one of the chief pillars of the artificial intelligence rally, OpenAI, may not be doing as well as you and I thought. It may not have hit key benchmarks as you and I thought. It may have over-ordered as you and I thought. And to read between the lines, it may bring the entire edifice down when the company, well, let's just say, tells us the truth. How about
as we said, it was discussed in the earlier video as well. OpenAI is not the end-all be-all. It is a very big player. It was the first player. It has, everyone knows ChatGPT, but we have other players that may be actually doing better than OpenAI. And even if OpenAI misses, it's not the end of the world.
that? When I read the piece, I was reminded of all the amazing hatchet jobs that I was forced to write in my multitude of journalistic haunts when I was younger. They ended up coming easy for me. You know why? Because you just have to pose enough truthful questions that the sum total is a death sentence for whoever you're writing about. After just a few months, you know what? I gave up fighting to be constructive and just decided if my editors wanted a hatchet job, I would give them a hatchet job. This journal piece of the art pictures. Thank you, Thomas Paine. This article was filled with such a hailstorm of fright that it finally captured images, and it's never bagged me. Now, it's entirely possible that she woke up this morning and she said, "Today is the day I'll make a national fool out of Jim Cramer by telling him things are great when they're really awful."
Yeah, well, that's not what I had in mind, Jim, but I don't know about that. Let's go and see if it has any other talking points.
But one there's Alphabet, Meta, and Microsoft, and that could all disappoint if this article has substance. Period. If I thought that you were going to lose money
to say about,
because of this, do you think I wouldn't
Amazon
shout it from the rooftops? I don't play for dinner. Let's go back to the rain metaphor for a moment, though. We're on the cusp of the big four tech earnings: Amazon, Alphabet, Meta, and Microsoft, and that could all.
Well, it's a crazy week. I think that tomorrow all of these companies are going to report earnings. I'm very excited to see what they have to say. I hope that they're going to keep spending. Maybe not as much as they have, but I do want to see the build-out continue. And I believe that they're still going to have revenue growth. And yeah, we're going to have to see. Maybe I'll make a video about that as well, maybe on Friday.
Disappointed if this article has substance. Honestly, that's exactly what this market may need, though. We need a shakeout of the fair weather soldiers and the fair weather shareholders.
I have some internet problems here, guys, and the internet comes and goes today, and I think that this is my cue to end it. Kramer. Let's see, is it back? Maybe it's back. If it's back, we're going to finish the video. If not, then I'm going to leave you here for today. No internet connection. Let me pause this recording. Okay, the internet's back. Let's continue. Wait.
Amazon, Alphabet, Meta, and Microsoft. And that could all disappoint if this article has substance. Honestly, that's exactly what this market may need, though. We need a shakeout of the fair weather soldiers and the fair weather shareholders. And we actually need to have some shorts built in. That's what rain does. That's how a market can continue. Otherwise, it will go bubblicious. We're also seeing a host of other stocks that are.
Yes, I agree with that. Maybe you should also short some companies. So if you think that they're way out there or, overvalued. I haven't actually shorted anything yet. I think that you should be, you should be using your resources into appreciating your wealth with companies that are growing and not bet against companies to go down unless your portfolio is large enough that you need to have a bet to save some dollars if the market crashes.
That have gone parabolic. ARM Holdings, which we own for the trust, Dell, AMD, which I wish we owned for the trust, and Corning, which reported this very morning. These stocks had threatened to touch the sun. Corning flew too close and had its Icarus moment today, tumbling nearly 9%. I told members of the investing club that it didn't really matter what Corning said, because its stock had gone parabolic, running so much that disappointment was indeed inevitable. Sell. It didn't matter if the company announced two huge clients, something that would have normally sent the stock barreling into the sun. Instead, it reacted to the rain and got clubbed. I say good. Corning did that too, even though my trust owns it. It's what we needed to see. Now, do all these parabolas mean that the entire move is kaput? No, not at all. What can you do to protect yourself from them? Here's an idea. The pros do what we call schnitzeling, taking a little bit out of the stock on each day of the parabolic move. You have 200 shares.
I actually agree with this one. If you have a stock that goes crazy and appreciates way too much, goes on a parabolic move, as Kramer here says, I think that it is good to dollar cost average out of the position a little bit and maybe not sell out of the complete position if you believe in the company. But you need to bring your allocation down to levels that you're okay with. You should always assume that the stocks can go down, and not necessarily to zero, but let's say you have a position that's like 10% of your portfolio, and if it drops half the price, you're going to lose 5% of your portfolio from just one stock. So buy low, sell high, and keep your allocations at the level that you're comfortable with.
Shares, you sell 50, and then you wait a little bit, then you sell another 50. If it keeps going higher, don't sell it all, but to make sure that you've sold down some. Then if the stock drops 5 to 7% from where you first sold, then you can begin to buy it back slowly but surely, 25 shares at a time. The goal is to be able to take advantage of the rain and do some planting further down. Otherwise, these...
I'm not actually... I don't actually agree with the 5 to 7% ups and downs. That's more like swing trading, more into the long-term stuff. And I think that if you let your stocks compound, that it is better for you. Those 5 and 7% stuff, it's too much volatility, too much hassle for me.
These cells feel like a SEAL clubbing expedition where you are the SEAL. I don't want that. What makes me so certain things are okay? The fourth industrial revolution. That's what. Do I know if OpenAI is going to be the best investment ever? You know what? Frankly, I don't care. What I care about is owning the stocks that are best prepared to benefit from the need to have compute, storage, and power. The three shortages that are driving the moves, like the one in Seagate this very evening. A memory disk drive, which just reported after the close is up 100 points. Of course, I keep the Chopper Trust diversified. We own a lot of companies for the trust that are not in the more or less malign data center space. We handled the nasty downdraft of tech innuendo when NVIDIA was 40 or 50 points lower than it is now. We'll handle that too. Here's the bottom. I'm not worried about the rain. My bottom line.
I agree with Kramer, as we have been saying here in this channel time and time again. We're here to buy the dips and to enjoy the ride up.
Mine says, newspapers, hedge funds, managers, panelists, commentators, you name it, bring it on. Especially the gas bags who can drum up.
Imagine if the stock market appreciated overnight to insane levels and then it just stayed there, flatlining, kangarooing, up and down, very small percentages for a couple of years. Then guys like us would be locked out of stocks, actually, because the stock market would have reached prices that it would need to reach in like 2, 3, 4, 5, 10 years, and it will stay there stagnant. So a little bit of volatility is actually good for us. So buy when you see the dips and you see the opportunities. Buy the total market, no matter what. Dollar cost average in good ETFs, the world ETF, the S&P 500 ETFs, and buy good, great companies, single stocks when the opportunity rises.
Up a storm if they have to. Instead, I worry about a lack of rain that will cause this market to self-immolate. Fortunately, today we got a nice shower of selling. Don't worry, more showers ahead. Can't handle it? Buy an umbrella. Brian, North Carolina. Brian.
How's it going, Jim? How's it going?
It is going well, Brian. We got the sell-off that we start to need in order to be able to cool things off so that we can refresh and go higher again.
Yes, absolutely. So I'm from Charlotte, North Carolina. B of A's headquarters are here, and I didn't know. I was just calling to see if you thought B of A was a buy or sell.
B of A is just a plain out.
I think that Bank of America is a very good company. It needs to hold. It's a core holding for most portfolios. I haven't bought Bank of America yet. I was very close to buying it in the dip, but I just wanted a little bit more margin of safety. I think that yes, Bank of America is a good buy, but for me personally, I'd have to wait for it to drop some more. Let me see actually what the price is right now. Bank of America stock. Yeah, well, I would like to buy over here, like $35. Maybe even 40. It reached like 47, 46. If it dropped like down to 40, I would have started the position.
Buy. The stock, first of all, is down 4% for the year. That's ridiculous in itself. Second, it sells at 12 times earnings, yet it's incredibly well run. This is an example of why I say this market's not dangerous. Bank of America is way too cheap. It should be bought. Let's go to Tony in North Carolina. Tony.
It's up 32% in the past year. It's not cheap at all. According to me, I don't think that it is cheap enough. It's a bank. It's a huge bank. It's kind of a legacy play. A core holding for sure, but not if it's up 32% the past year.
Hey, Jim, thanks for taking my call. I'm a first-time caller, club member, and I never miss your show.
Oh, thank you, buddy. Thank you.
Anyways, back 2 months ago, I bought 300 shares of Marvell Technology at $85. Today...
Good job, Tony. Good job. Good job, Tony. I was this close to buying Marvell. Unfortunately, it slipped through my fingers. I had put a buy at the $76 mark. I think it hit, but maybe I missed it and whoop to the moon. Marvell is a good company. I wouldn't buy right now at 150, but good job to Tony.
I sold half of those shares for $150. So the question I have is, what do I do with the shares I have left?
You're playing with the house's money, my friend. Here's what you do. You let it run. I think that you've got a total winner in Marvell, and you know what? You're not going to lose. What a great position. You're playing with the house's money. Let it run. If it gets to 200.
I agree with Kramer over here. Let it run. If it goes to 200, maybe sell like 10, 15%, and then just let it run. As we said, Marvell is a good play, in my opinion, and the AI infrastructure play is going to keep accelerating for the next few years, and I don't think that it is going to end less than 5 or 10 years in the future. So Marvell's price is just going to go up and up.
Maybe take a little off. Look, I'm not worried about a rain shower once in a while because sell-offs like the one we got today are healthy for any bull market. Without it, we'd be in danger. On Mad Money tonight, shares of Nucor are surging after the steelmakers blowout earnings report, and I'm getting the latest from the CEO to see if there's more upside ahead. Then as we wait for earnings D-Day tomorrow, I'm running through where things stand so far for the market this earnings season, and it's not bad. And baby boomers across the country settling into golden years. I'm sitting down with the CEO of one of the largest operators of senior housing communities to get the latest on the trend. So stay with Kramer.
Okay, that's it for today, guys. Thanks for watching, and I want to remind everyone it's better to buy than not buy. Just take a look at all that. See, it's up and up and up and up. I don't know where this is going to go, but I think that, in 50 years' time, I will be too old by then, let's say 30, 40 years, we're going to be way farther up than we are today. Keep a long-term mindset and pay yourself first, invest in your future. So that's it for today. Thanks for watching. Drop a comment what you would like for us to watch next. Maybe some stocks I should keep my eyes on. and I'm going to see you next time. Thanks for watching.